So, if you've been following the markets lately, you've probably felt it, right? That nagging anxiety as stocks that only seem to go up, well, now they only seem to go down. The old rules feel like they're totally broken. So what are you supposed to do when everything feels this uncertain?
This quote from way back in 1968 just nails that feeling perfectly. It's such a powerful reminder that the confusion we're all feeling right now, it's not new. This is just what history feels like when you're in the thick of it. The goal, then, isn't to wish all the chaos would just go away. It's to figure out how to navigate it.
So look, if you're feeling a bit lost right now, I get it. You are definitely not alone. The simple buy-the-dip strategies that seemed totally foolproof for years are suddenly not working. But what if there was a way to find some real clarity in all this chaos? That's exactly what we're going to dig into today, using the timeless wisdom of legendary analyst Harry Schultz to build a new framework.
All right, first things first, we've got to talk about a fundamental shift in your mindset. This isn't about finding some new trick or a magic indicator. Nope, this is about adopting a whole new philosophy for seeing the market clearly, especially when it's heading south.
And here's the absolute key. The goal isn't to be a permanent bull or a permanent bear. Think about it. An optimist is always just hoping for a turnaround. A pessimist is always expecting the next crash. But a realist just accepts the market for what it is right now. They can be a bull when the evidence is bullish, and then they can flip to being a bear when it turns bearish. And there's absolutely nothing inconsistent about that.
Okay, so to be a realist, you've got to know what you're up against, right? You have to understand the beast. So let's define it properly. What exactly is a bear market? Because it's a whole lot more than just a scary headline on the news.
See, a bear market isn't some random monster that just pops out of the shadows. It's a natural, almost inevitable correction. As the definition says, it's the market's way of dealing with that excessive public enthusiasm. When everyone gets a little too excited and pushes prices way, way beyond their real value. It's just part of the cycle.
And here's what's really fascinating. Not all bear markets are the same, not even close. Schultz breaks them down into 3 types. You've got your baby bears, which are really just quick little corrections. Then there are mama bears, the really serious, painful declines. And then you've got the papa bears. These are the big, bad, decade-long game changers. Knowing which kind of bear you might be facing is absolutely critical.
And hey, if you're thinking, oh, but these are rare events, well, think again. According to Schultz's research, for a huge chunk of the 20th century, the market was in a bear phase 35% of the time. Let that sink in. That's more than a third of all trading days. That one stat alone proves that learning to survive these downturns isn't just a good idea, it's essential.
Okay, this brings us to maybe the trickiest part of any downturn. You know the question, right? We're all asking it. Is this the bottom? The market just loves to send out false signals, preying on our hopes. So let's look at how a realist learns to read the real signs.
This slide here lays it out beautifully. Just look at the contrast. A market top, that's all about euphoria, high valuations, everyone agreeing things will only go up. But a bottom? A bottom forms in the exact opposite conditions. Bad news is literally everywhere, nobody has any confidence left, and trading volume is just pathetic because everyone is too scared to even touch the market.
And here it is, the single biggest trap in a bear market, the secondary reaction. You might know it as the sucker's rally. It's a sharp, fast rebound that really feels like the real deal. For a realist, it's a golden chance to sell at a better price. But for the hopeful optimist, it's a total trap that lures them back in right before the market takes its next leg down.
And this quote right here, man, it just drives the point home. It's not just the rookies who get fooled by these rallies. Even the experts, the talking heads you see on TV, they get swept up in all the excitement and start calling for a new bull market. This is exactly why you need objective tools, not just someone's opinion.
So, how do you avoid getting fooled? How do you sidestep all that hype? Well, you need a realist's toolbox, a set of objective indicators that help us measure the market's real health, cutting right through all the emotion and the media noise.
So let's crack open this toolbox, shall we? A realist uses these to get a true read. First, the advanced decline line. It tells you if the whole army of stocks is moving together or if it's just a few generals leading a charge. Then you've got new highs versus new lows. A healthy market has tons of stocks hitting new highs. A sick one, that list of new lows just keeps getting longer. Third, the odd lot balance index, which basically tracks the little guy.
Small investors tend to be most bullish right at the top and most bearish at the very bottom, which makes it a fantastic contrary indicator. And finally, volume, which is so important it gets its own slide. I want you to really pay attention to this quote. It reveals a huge secret. The worst declines don't start with some big, dramatic crash. They start with a quiet, low-volume bleed. While everyone else sees just a normal dip, the pros are quietly sneaking out the back door. Volume, or really the lack of it, tells you the real story. All right, so we've defined the bear, we've spotted its traps, and we've opened up the toolbox. Let's pull it all together into the single most important idea of all, a flexible mindset.
This, right here, is the big idea. This is the whole ballgame. Winning in the market isn't about being stubbornly right. It's about being flexible. It's having the courage to change your mind when the facts change. The flexible realist doesn't care about their ego. They only care about what's actually happening in the market.
So we're going to end with a quote that's, well, it's pretty famous, and yeah, it's a little brutal, but it perfectly captures the realist's mindset. When the panic is at its absolute peak, when confidence is at zero, when there is literally blood in the streets, that is the moment of maximum opportunity. It feels awful. It goes against every single human instinct you have. But as history shows us, it's precisely at those moments of maximum despair that the next great bull markets are born. The only question is, will you be thinking like a realist